Okay. Okay. Good morning. Today we're going to finish up Chapter 6, and we are going to start with this question. This relates back. We were talking on Monday, our chapter this week, about inventory and cost of goods sold, and we talked Monday about the difference between cost and selling price. And this question, sales revenue, meaning what we sell something for, is based on what price of the inventory, while the cost of goods sold, what's on our income statement, is based on blank of the inventory. So what we have here, 85% of you are right, which is really good, but let's go a little bit higher. Your sales revenue is always based on the sales price, your selling price. That's your sales revenue. Everything else, the cost of goods sold and the value of ending inventory, are based on the cost of that inventory. Okay, so that question is going to stay open for a little bit longer, and we're going to do several slides. The PowerPoint slides on Blackboard have a lot more detail than what I'm covering today. We're hitting the high points today. And again, yesterday I sent out links to step-by-step videos for all the homework problems. This chapter especially, it makes a lot of sense to have a step-by-step video because you do have to go step-by-step when you're doing the homework. Speaking of homework, Chapter 6 homework is due this weekend. It will take a little bit longer than many chapters just because these problems take a little bit of time to wade through them. The step-by-step videos will help very much on this, and it will be nice because you can pause them so you can open up the video in one window and do the homework in the other and go step-by-step. Okay, basic inventory formulas. Again, I just wanted to highlight these from Monday. These are not different from what we did on Monday. Just wanted to point out again that you do need those. And those are in the PowerPoint slides that you can download on Blackboard. Okay, now when we talk about the number of units in inventory, we know that because we keep track of it in our accounting records. When something is sold, we account for it as sold. When we purchase, it goes up. We do a physical count at year-end to make sure that that errors have not occurred. Physical counts are done at every business. When you're in stores and you see Regis Inventory Service or they have white or yellow tags on everything, they're doing an inventory count. And what they're doing is they're reconciling what their accounting records do say to what actually is there. Sometimes you have theft, sometimes you have errors, and so that gets corrected, and they do a physical inventory count at least once a year. We also have consigned goods. When you have goods on consignment, when goods are on consignment, whoever has the legal title, those goods are on their books. Okay, for example, I went into McKay Bricker one day, and in McKay Bricker was one of those black squirrel statues. It was about a foot high. It was real heavy. And I thought, oh, that'd be a perfect gift for my dad, who was a Kent State alum. So I got this statue, and I went to give her money, and she went, and she didn't ring it up at the register. She put it in an envelope, and I asked her about it, and she said that they don't own those black squirrels, but actually the university owns them, and the university gives her black squirrels on consignment. So McKay Bricker sells the black squirrel. The black squirrel money goes into an envelope, and then she gives it to the university. Presumably she gets some kind of commission on this. But those black squirrels that sit at McKay Bricker are owned by the university, and the value of those black squirrels are on the university's books, not on McKay Bricker. McKay Bricker does not have, if they were to do a balance sheet, those black squirrels would not be on their books. If they have artwork on display from various artists, that is not on McKay Bricker's books, that is on the artist's books. Okay, and in transit goods, we talked about FOB shipping point, FOB destination. When title transfers, that's when it goes on one balance sheet or the other. So you have to own it to actually have it on your balance sheet. It's not who physically holds it, it's the legal title owner who has it on the balance sheet. Oh, we did this already? Okay. Okay, now, there are two kinds of inventory systems. There's Perpetual inventory system. Perpetual inventory system keeps a running record of all goods bought, sold, and on hand. This is, you go to the grocery store and everything gets scanned. They are maintaining a perpetual inventory system. So every time you scan something, their inventory records are changed. Now, I know at Giant Eagle for a long time, if you would buy like 3 12-packs a pop, they would scan 1, multiply by 3. Then they eliminated that policy. And what was happening is you would buy 3 12-packs and they would be 3 different things. And the cashier would take one of them, multiply by 3 because it's the same dollar value. But what was happening is they were impacting their inventory records incorrectly. So now at Giant Eagle, they have a policy where you scan each item individually, and that's to try to keep their records right. They still, with Perpetual Inventory System, you still have to do inventory once a year. So Perpetual Inventory System is used a lot. You also have one, periodic inventory, and you only update inventory periodically. We're gonna do Perpetual Inventory. It's not a big deal difference at our point. The thing to know you should have in your notes, presumably for a question coming up, is Perpetual Inventory System keeps a running record of all goods bought, sold, and on hand. Okay? So Perpetual Inventory System keeps a running record. That's the one that keeps its running record of what's going on. Okay, so Perpetual Inventory System keeps a running record of all goods bought, sold, and on hand. Okay, so Perpetual Inventory System, what goes into the cost of inventory? And I got a question about this. Someone was working ahead on the homework. We have the purchase price of inventory, and that's the cost of inventory. But there's also other things that go into the cost of inventory, including the first one called freight in. Freight in is a very specific term. Freight in is what we pay to get our inventory to us. So we're buying merchandise to resell. The freight in is the cost of getting that merchandise to us. And it's actually called freight in. That word in is not a typo. It's freight in. That's part of the cost of inventory. Any purchase returns, any purchase allowances, any purchase discounts are subtracted. Just a refresher, purchase returns, we returned. That seems pretty evident. Purchase allowances are we purchased something and it wasn't quite right, so they gave us some money off. My son bought a refrigerator from H.H. Gregg, and they delivered it, and it had a small dent in it and at the point of delivery. So he pointed it out, and they offered him a $200 credit, or they would take the refrigerator back. And so he took the $200 credit. So if he had been buying this for a business, that would have been a $200 purchase allowance. So an allowance is given because something's not quite right. And then purchase discounts are given for paying within the discount period. When we said something like 210, net 30, when we pay early and take a discount, that's a purchase discount. So the cost of inventory is the purchase price plus any freight in, and then subtract the purchase discounts, allowances, and returns. So that's what's going into the cost of inventory. You won't have all these things when you're looking at inventory every time, but you need to know that freight in can add to the cost of the inventory. Okay, we're going to go through just a couple journal entries, talk about what's happening in each of these cases. Perpetual system. If we purchased $1,000 in merchandise, we've done this one before. We purchased $1,000 in merchandise. We're going to first of all debit inventory. It is a current asset. It's a short-term asset. Current asset, and we're going to credit accounts payable. We're assuming we're buying it on credit. So we're recording this purchase of merchandise. Okay, so that's a purchase of merchandise. Okay, so next one is if we bought the $1,000 of inventory, but we bought it when it was 210 net 30. Remember I talked about a purchase discount? So if we bought it when the discount terms are 210 net 30, we're going to, when we pay it back, we're taking the whole debt off. We had recorded it. Remember this prior slide? We bought the $1,000. We put $1,000 in accounts payable. So when we go to pay it off, we wipe out the $1,000 of accounts payable. But we don't have to pay $1,000. We get a discount. And the discount in this case, because we're paying within 10 days, we get a 2% discount. So the discount is 2% of $1,000, so $20. So I'm going to credit purchase discount, and then I'm going to credit cash for the $980 I actually have to pay. Okay, and then we have one other journal entry related to this, and it's when we make a return of inventory. Okay. We make a return of inventory. We're going to debit accounts payable, and we're going to credit inventory. Okay. Okay, now, next up is a question. I know I put it out there, and I see some answers coming in. If you've answered already, yeah, pretty good so far. Okay, so this question that's out there, an inventory system that uses computer software to keep a running record of inventory on hand. Doesn't it sound familiar, what we just did? That inventory system that uses computer software to keep a running record of inventory on hand is called periodic, perpetual, rolling, or current. And we just had it. Okay, need a few more responses to transfer in. When we're talking about an inventory system that uses computer software to keep a running record of inventory on hand, that running record of inventory on hand is key there, and it is going to be perpetual. I'm going to close this. We had 95%, right? So I'm going to close it. This is your final chance. Okay, so moving on. Now, on Monday, we did the 4 inventory methods, and we're going to compare those today. First of all, back to inventory cost. The cost of inventory, we said it was the cost of the inventory plus the freight in, less the discounts, allowances, and returns. It's also, if we buy inventory that's bulk packaged, let's say we buy several, I don't know, what could we buy? We could buy yarn. Let's say we buy bulk yarn. So it comes 144 skeins in this bulk package. And then we want to repackage it into packages of 4 skeins each. The cost of breaking down that bulk package and repackaging into 4s, that is part of the cost of inventory. So any cost you have to get the inventory ready to sell is part of the cost of that inventory as well. Okay, so you're going to take all the costs incurred to bring the asset to its inventory state, less any discounts you got, and that is the cost of your inventory. Now, we went through 4 inventory cost methods on Monday. We're going to build on that now. We're not doing the calculations today, but we're going to talk about each one. So specific unit, and again, the PowerPoint slides on Blackboard have a lot of detail on them. Specific unit can only be used with businesses with unique inventory items that are worth a lot of tracking costs. So we might use automobiles, antique furniture, real estate, jewels, and specific costs. We value everything at the specific cost of each particular unit. We can only do it with things that are pretty high cost and are uniquely identifiable. So we're not going to be able to use the specific identification method for many things. I would say most things we cannot use specific unit with. It's called specific unit or specific identification method. It's probably the one that makes the most sense, but on a scale, on a large scale, you cannot use it. It just wouldn't make sense. You'd spend so much more money tracking inventory than you make off inventory. So, automobiles, jewelry, real estate. We're talking about jewelry. We're talking about high-end jewelry. Real estate, obviously, is very, very unique. So these are specific identification, specific unit. Okay, so that's the first method. So we can't use it for very many companies, but it's there. Okay, so we know it exists. Then we go on to average. We call it weighted average. Sometimes we can just shorten it to average, but it is weighted average, meaning you just can't divide by 2. You have to weight it with the number of units. It's based on the average cost of inventory during the period. Okay, so we have weighted average. So specific unit, we can only use it in a couple situations. We have weighted average, which is used. And then we have the two and so weighted average isn't bad. We're going to do a problem coming up here on weighted average. But then we get to FIFO. And FIFO is the first units into inventory are the first units assigned to the cost of goods sold. So we assume that our oldest units are sold first. Ending inventory is based on the newest units. Okay, so FIFO, we have first units in are the first ones out, so the oldest units are sold first, the newest units are in ending inventory, so then LIFO is going to be the opposite of FIFO. The last ones in are the first ones sold. The oldest costs are in inventory. We're going to talk here in just a few minutes about why companies would choose LIFO or FIFO. If there's specific reasons why they would choose one of the two. Okay, now the next slide I have, the next two slides are really important. The next slide I have is giving you products that kind of mimic the inventory method. And then we're going to talk about what method companies choose. The method that the company chooses is not dictated by the product, except for specific units. Okay, so let's just go with this. I'm going to talk to you about each of these products, and then the next slide I'm going to talk about how you don't have to pick that method if you have that product. It might make sense. Okay, so specific unit for unique items. Average cost is we take our total cost, divide by our total items. FIFO, first in, first out. That means we're selling our oldest units first. And LIFO is our last units in, our most recent units are sold first. So these are cost flows. Now, types of products that you could use that mimic this flow. First of all, specific unit is anything high-end that has a serial number, so I was just picking aircraft, okay? Specific unit is weird, and it's the only method that the product dictates it. So you can only use specific unit if you have a high dollar product that is unique. Each one's unique, and you can track them individually. Okay, so average cost. When I think of average cost, I think of something like a cereal manufacturer. They're going to dump all those ingredients together, divide by the number of boxes they make, and that's an average cost sort of thing. So that's a way to think about average cost. Then, FIFO. Think about what's sold first in, first out. I like to think of a grocery store. There is a particular product that has to be sold first in, first out. And that particular product, if you think about it, you go to the milk refrigerator section, and milk is sold first in, first out, right? Because what they're doing is they're continually adding the new milk to the back of the case from the back behind. So you're always buying the oldest milk first. And why do you do that? Because if you bought the newest milk first, the oldest milk would be in back and it would spoil and be ruined. So they always try to sell milk on a FIFO basis. So milk emulates FIFO. You're selling your oldest milk first. Okay? You have to continually sell your oldest milk. Your newest milk is in the back of the case moving forward as you take more and more milk out. Okay, so then something that emulates the LIFO cost flow. LIFO cost flow, right there, that's a picture of a salt dome. You figure when a company has salt, they build it up in a big salt dome. And then when they use it, they're going in and they're getting the newest salt because that's on the outside of the pile. So they're continually using the most recent salt when they're using salt from a salt dome. So that would emulate the LIFO cost flows. Okay, now I said these are examples of how those cost flows work. So milk is like FIFO. You're selling your oldest milk first. The milk that's still in the refrigerator section is the newest milk. The salt domes, the salt that's left at the end of the winter is actually the oldest salt. It could be back this winter. We're going to have lots of salt left over, and so next winter when they use salt, the salt that's in the middle there of the salt dome that we can't get to, that's going to be from this winter because we haven't used it all. So, so I just told you about this. Now, the twist here is, see I said 4 inventory methods for cost flows. When companies choose an inventory method, they don't choose it based on their products other than for the specific unit method. So if companies choose average cost, FIFO, or LIFO, they can use any method they want. It is an assumption about the accounting cost flows. So when I said you can use any of 3 methods, I'm talking about the bottom 3. Specific unit is so special that it's kind of different, but I'm talking about weighted average, FIFO, and LIFO. Companies can use any of the 3 methods if they're not using specific unit. They can use any of the 3 methods regardless of the actual physical flow of product. So you could take milk and you could say, I'm going to use the LIFO method for it. And that would be all right. Once you pick a method, you choose between average, FIFO, and LIFO, and the choice is the flow of costs. You make a choice and you stick with it. So companies will choose to use an accounting method and will stick with it. They do not change inventory methods year to year. So they're going to say, I'm going to pick this method and I'm going to stick to it. And that's what they do. So it is, when we're choosing an inventory method, it's for accounting cost flows only. It doesn't reflect the actual physical flow of the goods. Okay, so doesn't matter about the physical flow of goods, just you pick a method and you stick with it. And before today's over, we will talk about why companies choose the method they choose. There's incentives for different methods. Okay, so now, okay, we're going to do this little chart, which is talking about FIFO and LIFO. We're going to compare those two. You've got FIFO on one extreme where you're using the, you're selling your oldest units first, and you've got LIFO, you're selling your newest units first, and this is in terms of cost flows. So we've got 2 extremes, and then weighted average is in the middle somewhere. So we're just going to talk about the 2 extremes. So we're going to compare FIFO to LIFO. Under FIFO, your oldest units go into expense. Okay? So your oldest units go into expense. Your newest units are in ending inventory. Your newest units under FIFO are in LIFO. LIFO has our newest units in cost of goods sold, and LIFO has our oldest units in ending inventory. I would have this written down because it's going to help you a lot when you're doing your homework or even questions coming up in here. This kind of summarizes it. And if you think about it, you can reconstruct this chart. If you think about FIFO, FIFO is first in, first out. That means our oldest units, our first units, are sold. So that's cost of goods sold, oldest units, ending inventory, and their FIFO then has to be the newest units. And then LIFO is the opposite. So this is a really good chart to have. We have at least one question coming up that specifically uses it. If you have this written down, you will be able to answer a question that's coming up probably in 10 minutes or so. So make sure you have this. This is a nice summary. Okay, so we're going to move on here. Now, we have a question. I've not sent this out yet because I want to work through this with you, and then I'll send it out. So let's talk about this. A company has a beginning inventory of $40,000 and purchases during the year of $110,000. Okay, before I go any further, in my notes, I would write BI, $40,000, and purchases $110,000. So then you know your total cost of goods available for sale is $150,000. So this should be written down somewhere. Total cost, $150,000. Now I'm skipping to the last sentence. It says the average cost per unit. So we're using the weighted average method. So weighted average method takes our total cost, divides by our total units. So we said our total cost was $150,000, right? Because that's the $40,000 and the $110,000. Now it tells us the beginning inventory was 3,000 units and 7,000 were purchased. So our total units were 10,000, right? So 3,000 plus the 7. So when we're doing our average cost per unit, we're going to take that total cost. The total cost is the beginning inventory plus the purchases and divide it by the total unit. And the math should be pretty straightforward. So I'll put it out there now. $100% correct so far. Good. Okay, so our average cost, how we're going to get this, we're going to take that beginning inventory of 40,000, the purchases of 110, added together, that's 150,000. And we're going to divide it by the total number of units. The total number of units is the beginning inventory of 3,000 plus the purchase of 7,000. So you're taking 150,000, dividing by 10,000 on this. Pretty good so far. $99% correct. That's good. So you've taken 150,000 divided by 10,000 units. We're going to close this in about 5 seconds. Ooh, we're at 100%. Cool. But we have 5 more to answer. So it's your last chance to get an answer in. Time is ticking. Last chance. We have 100% in right now. I mean, we have 100%. Make sure you've got your answer in. Okay, now talking about FIFO and LIFO. Let's assume that average cost is somewhere in between them. So again, we're going to talk about FIFO and LIFO. This is Exhibit 6-8 in your book. And what I've done is I've kind of shortened it up so I don't have the long sentences here. But Exhibit 6-8 in your book has one panel where it says, if costs are increasing, this is the case. And then the bottom panel is if costs are decreasing. So we're starting with costs are increasing. If costs are increasing, cost of goods sold under FIFO will have the lowest cost of goods sold and the gross profit will be the highest. Gross profit is sales minus cost of goods sold. Okay? So what I've done is I've taken that table, I've paraphrased it down, boiled it down to what's really important out of there. Okay, so FIFO. If I want the highest gross profit, I'm going to choose FIFO. So I'm going to choose between FIFO and LIFO. Weighted average will be somewhere in the middle. Okay, so FIFO is going to have the highest ending inventory. So FIFO, I'm going to show the most dollars on my balance sheet. I'm going to show the most profit on my income statement. If costs are increasing, that's the key. So this panel that we're looking at is costs are increasing. Now, once we do FIFO, we know what LIFO is going to be because LIFO is going to be the exact opposite of that. Okay, so when we talk about LIFO, cost of goods sold is highest, gross profit is lowest, and ending inventory is lowest. Okay, if costs were increasing and there were no taxes, so let's ignore income taxes for the moment. If costs were increasing, which we have inflation over time, so a lot of things increasing in costs, companies, if they wanted the highest profit, would choose the FIFO method because they're going to show the highest profit and they're going to show the highest value on the balance sheet if costs are increasing. If we ignore taxes. Just want to point out this is panel A. Panel A is when costs are increasing. Panel B is everything the opposite of that. So inventory costs are decreasing, it's going to be the opposite. Okay, so if costs are decreasing, if we're talking about certain technology costs are falling, then you're going to have the opposite answers to what we just talked about. Now, I said that companies would choose FIFO if you ignored taxes, because FIFO is going to show the highest net income, okay? Because it's going to show the highest gross profit because under FIFO, if costs are going up, cost of goods sold is the lowest. And if costs are decreasing, then everything's backwards. And I said ignore tax. Now we're going to, for one of the few times in this course, we're going to talk about taxes. So companies pay taxes, and there is a tax advantage to using LIFO if costs are increasing. Well, okay. Back to this one, we said gross profit's the highest with FIFO. Gross profit is the lowest with LIFO. There is a tax advantage to LIFO, and let's go. Okay, so here's the tax advantage of LIFO. Let's assume costs are going up, okay? If costs are going up, LIFO is going to result in the lowest income. It results in the lowest income taxes. If we have the lowest taxable income, we have the lowest taxes, which results in increases the cash available for a company to use because it's not putting cash towards income taxes. This is one of the few cases where you absolutely have to use the same method for taxes as you do for financial statements. So when you make a choice on your financial statements to use FIFO, you have to use FIFO on your taxes. If you make a choice of LIFO on your financial statements, you have to use LIFO on your taxes. If costs are increasing, LIFO will give companies a big tax advantage. And they'll get more cash back. They'll save cash so they don't have to pay as much tax, so then they can reinvest it and make more money. LIFO has a huge tax advantage to companies. There's a couple things to be aware of. LIFO is not permitted under International Financial Reporting Standards. So if companies are reporting using IFRS, they can't use LIFO. Just about every time Congress talks about tax refining the tax code, they talk about eliminating LIFO as a method. And the reason they're doing that, if they talk about eliminating LIFO, is immediately the IRS would collect millions and millions of dollars from companies if they had to change from LIFO to FIFO. It would trigger a huge tax bill. So LIFO is attractive from a tax standpoint. Investors, when you open up somebody's financial statements, it will tell you, do they use FIFO or LIFO? And if they see that the company uses LIFO, they know immediately that what that means in terms of taxes and income. Okay, so comparing FIFO to LIFO, remembering that weighted average is somewhere in the middle. Cost of goods sold under LIFO will be more realistic for net income. More recent costs are assigned to cost of goods sold. So LIFO is going to give you a more realistic net income. Ending inventory will be more realistic under FIFO. So the company really has to consider what it wants to accomplish, and investors know this. So when they look at a company's balance sheet and they see that the company is using FIFO, they can adjust that in their mind, that they know that they're using the most realistic numbers for balance sheets. So there's not a magic answer for any company. But once they pick a method, they stick with it. Okay, next up, we've got a couple questions on what we just went over. First one, the FIFO method assigns the most recent inventory cost to expense. Okay, FIFO means your first ones out, or your first ones are the first ones sold. So your earliest inventory goes to sell, which is to expense. I would ask you, you should probably look at that little chart like we did. You wrote it down, it looks like here. Most recent is like newest. When we're talking about most recent means newest. So the FIFO method assigns the most recent or newest inventory cost to expense. Is that true or false? So we're saying the most recent, newest inventory cost to expense, FIFO. Okay, when you answer this, you're saying true or false, so FIFO. So when you're talking about FIFO, you're talking about this column, okay? So most recent means newest. Expense, you'd have to look down here at expense. So you're saying, is this true or false? Are those going to be the newest expenses, newest units in expense? Okay, again, right now I've got 88% of you right. So look at this carefully. Look at your screen. It says the FIFO method, so you're looking at the FIFO column, right? Assigns the most recent. Recent means newest. Inventory cost to expense. expense. Okay? So is that true or false? So you're looking at expense row, FIFO column. Is it the most recent or the newest unit? %90 of you are right, so do take a second look to make sure you're not part of the 10% that are wrong. FIFO column, cost of goods sold. What I'm asking is I'm saying recent. Recent means newest. So are these the newest units in expense under FIFO? Is that true or false? Okay. I guess we're only going to get 110. Okay. Any last minute changers here? We're up to 92%. Do take a look. I'm asking that intersection of FIFO and expense, is that recent or newest units? Is that true or false? Is how you interpret this. Okay, that is false. It is the oldest units, and that's how you interpret this table. It's got it right there for you. So there's one. Okay, so let's try one more. Okay, this one, this is the specific unit method that we said at the beginning was one of those special methods. Which of the following businesses would use a specific unit cost to account for inventory? Automobiles, jewelry, we're talking high-end jewelry, real estate, or all of the above? You may want to look back at your notes. We use these examples. Think about specific unit can only be used for high-end things that can high-dollar items that can be uniquely identified. So we're looking here, automobiles have serial numbers. They're pretty expensive. Jewelry, we're assuming it's high-end jewelry that is unique. Real estate is unique. Okay, everything has a parcel number, etc. So which of the following would use specific unit cost method? Okay, last chance to get your answer in. Again, specific unit can only be used with high cost items that can be uniquely identifiable. As we go through this list, automobiles have serial numbers and are high dollar. Jewelry, high-end jewelry, is uniquely identifiable and it's high cost. Real estate, everything has a parcel number and real estate's expensive, or all of the above. So last chance to get your answer in. Okay, and it is all of the above. Okay. Okay, now we're going to switch gears for a moment and talk about Caesar's Palace in Las Vegas. Okay, so we're still talking about inventory, and normally when you think about Caesar's Palace in Las Vegas, you don't think about inventory, but they do have inventory. When you go into the hotel, if you go into a guest room, every guest room has a minibar, and that minibar in the fridge will have lots of snacks and drinks in that. And those items in there, Caesar's Palace is pretty big, and they have inventory. So they keep track of the inventory, and then they sell it. So, got a question. So all the items that are in all the mini fridges throughout Caesar's Palace, which is huge, I think they have something like 5,600 rooms or something like that. So they've got snacks and beverages in all the rooms, and then they have a warehouse room where they keep more so they can restock. So here's the question to you. The cost of all those items, which financial statement, just going back to basics here, which financial statement would you find the cost of the snacks and beverages that had not yet been sold as of December 31st? So okay. On which financial statement would you find the cost of those snacks or beverages that had not yet been sold as of December 31st? Okay, now, right now I think we're going around 63% correct. So when we think about this, the snacks and beverages that have not yet been sold, those are inventory, okay? So inventory. Caesar's Palace includes those. It's actually Caesar's Entertainment Corporation owns Caesar's Palace. So they have those, they have inventory. So what financial statement? There is only one financial statement that inventory belongs on, okay? So what financial statement does inventory belong on? Okay, let's start eliminating answers, okay? So inventory. Inventory is what kind of account? An asset, right? Assets, when we talk about the income statement, the format of an income statement is sales revenue minus expenses gives us net income, basically. So we have revenues and expenses gives you net income. Inventory is not part of that statement at all, right? The statement of retained earnings, and I'm going through all four statements right here just to give you a review. So we know that income statement, first of all, somewhere in the margin, you need to write that inventory is an asset, right? You know that inventory is an asset. That's what we're talking about in this chapter. That's what we started with. Okay, so income statement is sales revenue minus expenses gives us income. Statement of retained earnings. Statement of retained earnings starts with last period's retained earnings, adds in net income from this period, subtracts out any dividends we declared, gives us ending retained earnings. Okay? The balance sheet is the accounting equation, right? The accounting equation is assets equal liabilities plus equity. So balance sheet is assets equal liabilities plus equity. And the statement of cash flows is beginning cash plus a lot of activities equals ending cash, kind of, sort of. Okay? So of those statements, where would you find inventory? Okay. So good, we've made it up to 84% correct. Okay? Again, inventory is an asset. Keep that in mind. I'm not going to put up the answer, but if you write down what I'm telling you right now, as I go through, you will absolutely get the right answer. Inventory is an asset. Asset, key word, asset. Okay? So which statement is inventory on? Income statement is revenues minus expenses. Statement of retained earnings is beginning retained earnings plus net income equals ending retained earnings. Balance sheet is the accounting equation, assets equal liabilities plus equity. Statement of cash flows is beginning cash plus a bunch of activities equals ending cash. Okay, we're going to close this one in about 5 seconds, so get your answer in. Okay, so it is balance sheet. Inventory, the subject of this chapter, is on the balance sheet. It's a current asset on the balance sheet. Okay, now, in the minibar, we have Coca-Cola, okay? So this, and I'm going to do this for one can sale because it's easier to think about one thing. Okay, so Caesar's Palace, let's assume they pay $1 for a can. And let's say they charge the hotel guests $4. The minibar items are marked up anywhere from 75 to 400%. It's just an industry thing. If you go buy minibar items, are really expensive. So let's say, for the sake of argument, that this can of Coke cost Caesar's Palace $1. They charge the hotel guest $4. So one can of Coke. Okay. So let me ask you this question now. So we have this one can of Diet Coke, and it cost Caesar's Palace $1. They charge hotel guests $4. So this question, what cost would 1 can of Diet Coke be carried on the balance sheet at? Would it be carried on the balance sheet at $1 or at $4? So we'll put up this question. Okay, this goes back to the very first question we started class with today. And we talked about this Monday, we always carry inventory on our balance sheet at our cost. We don't carry it on what we're going to sell it for. The only thing we ever use sales revenue for is on the income statement sales revenue. But when we're talking about our balance sheet, we carry inventory at our cost. So what cost would 1 can of Diet Coke be carried on that balance sheet at? Going to close this in about 5 seconds. Okay. This is a really basic thing. We're carrying things on balance sheet at our cost. About 3 seconds. Okay. It's at $1, okay? So the inventory is always carried at cost. Okay, let's go a little further with this example. Okay? Next up, Diet cans. When we record, let's say we sell 1 can of Diet Coke. There are 2 entries required. The first entry, we're going to debit cash, the guest will pay cash, and sales revenue. So that's to record the sale of the can of Diet Coke. We also, though, need to record the cost of inventory, to record the cost of that sale. So we're going to debit cost of goods sold, which is an expense, and we're going to credit inventory. Okay, so what we've got here, we record the sale, we record the cost of sale. So what's happened is we've made, if you think basically what's happened here is Caesar's Palace has made $3, right? Because they bought the Coke for $1, sold it for $4. So basically they made $3. The $3 is, so what we're going to do here, let me ask this. I'm going to put this out. What is the impact on Caesar's assets resulting from the sale of 1 can of Diet Coke? So I'm going to push this question out, and then I'm going to show you what we're talking about here. Okay? So this question exists right now. Let me see. Let me go. Okay. So what's the impact on assets? So that's what I want to show you. So now we're going to go, good, 91% right already, but let's just go forward. Okay, so the impact on financial position from sale of 1 can of Coke. So here's the first journal entry. First journal entry, we sell that 1 can of Coke. We're going to see assets increase by $4. We're going to see sales revenue increase by $4. So we've got assets going up by $4 and equity going up by $4 as well. And then we have the second entry to record the cost of the sale. So what's happening here is equity goes down by, oh, there's a window. Equity goes down by, okay, so cost of goods sold, equity decreases by $1, and then assets decrease by $1 as well. So the overall impact is assets go up by $3 because our cash goes up, inventory goes down, but assets go up by $3. Income goes up by $3. Income affects equity. So when we're looking at this question that's out there right now, assets will increase by $3. Okay, so the answer is assets will increase by $3. I'm going to close this question in about 5 seconds. So it is assets, they increased by $3. Okay, 93% of you are right. Assets increased by $3 is the answer. There's no tricks here. Okay, so that $3 increase, and then, okay, so now we're moving on. Okay, there are 3 accounting principles related to inventory. Disclosure means we're going to disclose on our books what method we're using and other information. Representational faithfulness means that what's on our financial statements actually represents what we mean it to represent, that's not misleading, and that we use the same method over and over, consistency. Okay, so there's 3 methods. I'm going to ask you a question coming up. It's going to say, which of the following is not one of the accounting principles relevant to inventory? There are 3 principles relevant to inventory: disclosure, representational faithfulness, and consistency. You need to have all 3 written down because we're going to have a question that says which one is not. Okay, so disclosure, representational faithfulness, and consistency. Just a couple concepts left in this chapter. We have something called the lower of cost or market rule. Inventories reported at the lower of the historical cost or market value. Emphasis on the word lower. So we will look at the end of a period, we'll look to see what the inventory's cost is, and we'll look at its current market value, which is its replacement value, and whichever one's lower is what we record it at. I'm going to edit the slide. Okay, so inventory is reported at the lower of historical cost or market value. Market value is also known as current replacement value. Okay, I've sent out a question. Okay, I'm going to come back to this slide in just a minute, but the question that I just sent out, the lower of cost or market rule requires a company to report inventories at the lower of what? So you have those choices, you can see those choices. I'm going to go back here, and this is what the question is referring to. Be very careful to read the words carefully. Don't just pick the first answer necessarily. Okay, so this question, the lower of cost or market rule requires the company to report inventories at the lower of. Okay, so get your answer in. Again, it's been on the screen. Just pick the answer that it matches up. Okay, when you're answering this question, we're looking for inventories reported at the lower of historical cost or current replacement value, okay? That's what inventory is reported at, the lower of those two things. You need to know that. This question is closing in 5 seconds. It's historical cost or current replacement cost. Okay? We never report inventory at current sales price. Sales price is only used for sales revenue. Sales invoice price also. FIFO and LIFO, we don't report it at the lower of that, so that doesn't impact us at all. Okay, now question 20. This is going back to something we talked about. This is just like one little nuance here. Let's see. Just want to give a quick here. The weighted average per unit, cost per unit, is calculated as the cost of goods sold divided by the number of units actually sold. Okay, I'm going to shock a bunch of you looking at the results, and I would expect to on this one. The weighted average cost per unit is calculated as the cost of goods sold divided by the number of units actually sold. That is not right. It's by the number of units actually purchased or produced, not sold. Okay? So watch that. It's one word different, but it means a whole bit. You don't divide by the number of units you sold. You take your total available and divide by the total number of units available, which is, you know, purchased or produced. So make sure you're not falling for the sold trick there. Okay? I'm going to close this in 5 seconds. Last chance to get your answer in. Okay, and then the last one before we move on, which of the following accounting principles, as promised, which one of these is not one of those principles that I put up? Okay, so which of the following principles do not have special relevance to inventories? These are the 3 items I told you to write down, right? So there are 3 items. Write them down. The one that's not, I'm going to close this in 5 seconds. Okay, again, this is right out of what we just said, what we talked about, the 3. We need these 3. So, okay, the one that we didn't talk about, revenue is not a principle. Revenue is something that goes on the income statement. Okay, so now we're going to go on and we're going to go back because I want to review something back to accounts receivable. So back to, because Caesar's Palace was on my mind yesterday as I was thinking, and I thought it would be useful to go back to accounts receivable, which is last week. Accounts receivable, Caesar's Palace. Okay, so when gamblers go to Caesar's Palace or any casino, typically you can take out a loan to gamble. But when you go, you have to fill out, there's steps you do, okay? So, in our story here, you go to Caesar's Palace or any casino, you can insert any casino in this, and you can apply for a loan. And what they do is they look to make sure you have enough money in your checking account. So this person goes and says, I want credit for $5,000. So Caesar's Palace will go, oh, okay, you have $5,000 in your checking account or in your savings account. We'll extend credit to you for $5,000. So all Caesar's Palace has done at that point is approved their loan application. Okay, so at this point, no money has changed hands. They have just said, okay, we will loan you up to $5,000. So you go, when you go to a casino, you go up, you do an application, and this is what happens. So, okay, then what happens, let's say you proceed on and you go to the blackjack table and you say to the dealer, I want $500 of chips. What's going to happen at that moment is the dealer is going to give you what's called a marker, okay? And this is a copy of an actual marker, and it looks like a check. And it actually is drawn on your account, your checking account. You sign it. It's a legal document. This is a marker. So at the moment you sign this, you owe Caesars $500 because they've just dispensed to you $500 worth of chips, okay? So now, this is a sample marker policy. If your marker is $0 to $10,000, you have to, they will be deposited within 15 days, $10,000 to $50,000 within 30 days. So you've got a certain amount of time to deposit it. Markers, individuals use markers because they don't have to carry piles of cash around with them to tables. They also don't have to incur ATM fees. And typically, markers don't have interest on them. So there are cases where individuals have gone to casinos and used markers to borrow cash. It's interest-free. You have to pay it back. Sometimes they do, sometimes they don't. But at the moment where you sign that marker, Caesars Palace has accounts receivable with you. Okay, so their accounts receivable at Caesars Palace are these markers. Okay, so let me just ask you, based on this scenario, okay, will Caesars recognize a receivable at the time the gambler's loan application is approved? So in our little facts here, where we went with we get approved for $5,000 loan, haven't taken any cash yet. Okay, this is your freebie. Okay, no. Because all they've done is they've approved it. They haven't loaned you any money yet. They've just said, you're good for $5,000. So make sure your answer is no. Make sure it's no. Come on. Get your answer in. This is easy. Okay, and then okay, and then the other question is, will Caesars recognize a receivable at the time we sign the marker and give out the $500 of chips at the table? Chips are basically cash. You can cash them in for cash. And the answer is yes, okay? So Caesars has receivables. So if you ever go into a casino and you see them giving out, the dealers giving out chips, there are receivables in the making right there. Okay. So that's it for today. This chapter 6 homework is due this weekend. I sent out step-by-step videos for the homework, and I would encourage you to use them. So I'll see you on Monday.